Hello, my name is Doug Pless. I'm a full-time trader and a SpotGamma content contributor. This presentation is a case study that shows how to use a variety of SpotGamma tools to find and plan a trade in the S&P 500 index. The instrument selected for this case study is SPX options, showing an intraday trade on November 13. The setup that I will cover is based on my analysis and thesis for SPX. This setup could have been taken with SPX, SPY, or XSP options. Position duration or time frame could have been intraday or longer. For this trade, my instrument was SPX options, and the duration of the trade was intraday. Here's the agenda for this presentation. First, I'll go over a brief overview of the S&P 500 index, SPX. Next, I'll cover my planning process, how I use SpotGamma tools to analyze an instrument, and how I develop a thesis. Then I'll discuss trade execution for the case study. Finally, I'll review the key takeaways for this case study. The S&P 500 index, or SPX, is a market cap weighted stock market index that tracks the performance of 500 of the largest publicly traded companies in the United States. SPX options trade on the CBOE. They are cash settled and European style, meaning they have no early assignment risk and no risk of being assigned physical shares. SPX has options that expire every trading day. These zero DTE options are often key drivers of price. Finally, SPX options are very liquid and trade in heavy volume. For pre-trade planning, I look at the following data. I look at the SpotGamma key daily levels and how they change from day to day. I also look at trace heat maps. I start with gamma around the open to see how market makers are positioned. Finally, I look at the HIRO indicator. Before moving on to the case study, let's briefly look at some background information and explanations of these levels and charts used in the case study. The key daily levels are available on the dashboard home screen, in the data table at the bottom of the Founder's Note, and in Equity Hub. They are updated every day and are proprietary to SpotGamma. The absolute gamma strike is the strike with the largest absolute positive and negative gamma. The volatility trigger is SpotGamma's proprietary gamma flip level, with positive gamma above and negative gamma below. In a positive gamma environment, market makers have to trade against price to hedge their delta exposure. This tends to subdue or decrease volatility. In a negative gamma environment, market makers have to trade with price to hedge their delta exposure. This tends to enhance or increase volatility. The call wall is a strike with large net positive gamma. It can act as resistance, since market makers will most likely have to increase delta hedging at this level. The put wall is a strike with large net negative gamma. It can act as support. For this trade, I use the trace gamma heat map. It is also proprietary to SpotGamma, and it updated every 10 minutes. The trace gamma heat map shows areas of positive and negative market maker gamma for SPX. Blue zones indicate positive market maker gamma. Red zones indicate negative gamma. Darker colors indicate stronger gamma. Traders should expect lower volatility in positive gamma, that's the blue zones, and higher volatility in negative gamma, that's the red zones. The SpotGamma HIRO indicator shows the market maker hedging impact of options trades. It is also proprietary to SpotGamma and is updated in real time. Market maker hedging flow can have a significant impact on price. This chart shows calls and puts separately for a combined signal of all of the S&P 500 index stocks. The candlesticks show price for SPX. The orange line shows calls. The blue line shows puts. A rising orange line indicates traders are buying calls. A rising blue line indicates traders are selling puts, and vice versa. Let's move on to the case study. Here's my thesis and plan for this trade. I was looking for moderate to high volatility due to the mildly negative gamma and lower stability index shown on the trace gamma heat map. I plan to watch HIRO in the first 15 to 30 minutes to see if traders were buying or selling SPX, SPY, and S&P 500 equity calls and puts. I expected a trending market based on negative gamma and the lower stability index. Let's look at the basis for this thesis. This is the trace gamma heat map at 9:30 a.m. Eastern Time on Thursday, November 13th. It shows SPX was trading a mildly negative gamma at the open. The stability index at 31% showed lower stability and the potential for movement in a trending market. SPX initially traded lower after the open. Around 10:05 a.m. Eastern Time, traders started buying calls and selling puts in S&P 500 equities, shown by the rising orange and blue lines respectively in the HIRO chart. SPX reversed higher for about 10 minutes. Around 10:15 a.m., options traders reversed their positions and began buying puts and selling calls, shown by labels 1A and 1B respectively in the HIRO chart. When traders buy puts and sell calls, market makers take the opposite side of the trades and sell puts and buy calls. Since market makers want to remain delta neutral, they had to sell stock and ES futures to hedge their delta exposure. At 9:40 a.m., a large 99 percentile strike appeared on the trace gamma heat map at 67.70 and a negative gamma strike 5 points below at 67.65. The 67.70 strike is shown on the heat map with label 2. This showed that traders had sold a 67.70, 67.65 put spread, and market makers were long the spread. The large 99 percentile strikes often act as magnets for price intraday. As SPX reversed lower just after 10:15 a.m., I sold an SPX 13 November, that's 0 DTE, 68.20, 68.25 call spread for $2.70 credit per contract. My target was the 67.70 positive gamma exposure strike. A few minutes after 11 a.m., SPX reached the 67.70 target and traders stopped selling calls and slowed down buying puts. I was looking for potential mean reversion, so I sold an SPX 13 November, again 0 DTE, 67.70, 67.65 put spread for $2.15 credit per contract. This turned the position into an iron condor with a total risk of 15 cents per contract. SPX chopped around between 67.65 and 67.80 and finally broke below the 67.65 strike around 1 p.m. I closed the position at that time for a profit of $1.80 per contract and a risk of 15 cents per contract. The reward to risk for the trade was 12-1. This screenshot of the Thinkorswim Analyze tab shows the position for one contract right before I closed it. Here are the key takeaways for this case study. First, the negative gamma and lower stability index on the trace gamma heat map indicated higher volatility and the potential for a trending market. Next, HIRO provided a clear signal that traders were buying S&P 500 equity puts and selling calls, and market makers were selling stocks and ES futures to hedge their delta exposure. Finally, the 67.70 99 percentile positive gamma strike shown on the trace gamma heat map provided a clear target for a short setup. That wraps up this case study. Thank you for watching.